Welcome to Real Estate 360 Live with Ryan Sloper, the trusted name in real estate radio. Now, here's Ryan Sloper.
Welcome, everyone, to another episode of Real Estate 360 Live. For those of you not familiar with the podcast, my guest and I will do a weekly podcast covering all things real estate, from interest rates to the economy to what's happening in Washington. Anything that affects your real estate decisions will be covered here. As I say each and every week, you're not going to necessarily hear us on here just cheerleading about how, low interest rate environment and why it's such a great time to buy. We're going to give you the real information that you need, what's behind the scenes that's taking place that's driving interest rates, why we're not seeing the actual demand for real estate in a low interest rate environment that we have right now that we should be seeing. What's taking place at the Federal Reserve and their thoughts on the overall markets, and the reason why that's so important is because we have artificial markets that have been created by the Fed, mainly to the benefit of the big banks and hedge funds and the rich, which, it's everything sounds great because everybody's happy right now because everybody in most areas has, rising home values, which, gives people a reason to be happy, positive consumer sentiment. But the real story of what's taking place is not as rosy as the picture that's painted by the media. So we're going to dive into a couple things today. It looks like the Federal Reserve could be changing their tune on where the economy is headed. We're going to jump into that. We're going to talk about loan production. So the overall loan volume that's actually been originated or put out there from 1 year ago is down 55%, which is an incredible number, so we're going to kind of dive into that a little bit. Joining me on our panel, as he does each and every week to discuss the issues, is Louis Camerosano. Louis is a former school teacher, a former attorney, and a former general manager of a major real estate portal. Louis is often cited in the media as a real estate industry expert, been cited in Inman, Wall Street Journal, Fox Business, U.S. News, Wall Street Journal, MSNBC, and numerous others. Louis, how you doing today?
Doing grand, Ryan. How are you?
I'm doing well. Great to have you on, as always. And, we've had a little bit transpire over the last week. I want to kind of start, obviously, yesterday we had the initial jobless claims, which you and I always talk. The way that they spin this news is incredible because jobless claims came in, I want to say it was about 20,000 less than what was expected. 300,000 versus the 320,000 that they were expecting, and the continuing claims also dropped. But the way that the media spun this was that jobless claims are at a 7-year low, right? As if all of a sudden, things are getting better because they can throw this whole 7-year thing into the mix, right? And the fact of the matter is that we have more and more people falling out of the job market altogether. It's really irrelevant to me that these jobless claims are going down. I don't even really put much stock into it, but once again, it looks like, the media is looking for something to hang on to make it seem like the economy is moving in the right direction. But what I wanted to touch on is that the Fed, actually, I believe it was yesterday. Let me see here, make sure I have my days right. Yes, they revealed Wednesday that in between its last two Federal Open Market Committee meetings, that it held an emergency meeting to discuss market changes, and that the Federal Reserve is prepared to hold the federal funds rate near zero as long as inflation remains low. Well, I'm kind of curious as to what they felt like warranted an emergency meeting to discuss market changes. What did they see in the market that changed between, their two open meetings that they had, and especially when they were out there saying that, it was just weather-related. So the Fed minutes that had came out, which is basically, the overall report from the meeting from the previous month. So that came out, and the findings I thought were a little bit interesting because from the Fed minutes from March meeting, the report was probably about 23 pages long, and about 8,700 words, compared to the previous meeting, which was only about 2 pages long. And there was a lot of extra detail in there about the health of the U.S. economy. But they kind of dove into housing quite a bit. And they had mentioned that the U.S. economy obviously was not necessarily moving in the right direction. They felt like that they did note that there was a general housing market slowdown in January and February compared to the end of 2013, and that it was really troubling the Fed because that permits for single-family homes had failed to show sustained improvement since the last spring. And many of the Fed members were concerned that it was rising mortgage interest rates that may have produced a larger than expected reduction in home sales. Well, Lewis, isn't most of this common sense? I mean, what took them so long to come to the realization that things weren't going right in the housing sector when we had almost a third of all the transactions being cash transactions, which all this information is readily available to them, that now all of a sudden they need to hold emergency meetings in between to discuss the health of the markets. So you mean they finally wised up to it just wasn't the weather that's not generating results? What's your take on this as far as what's taking place with the Fed, what's taking place with initial jobless claims, and where we're headed into this spring market?
Okay. Ryan, you had suggested last year that the Fed wasn't going to taper because they couldn't taper because the economy wasn't getting better and they needed to continue the stimulus. I suggested that they would taper, not because I disagreed with you, but just because they did not want to appear as if QE was forever, and they wanted to show that, look, it's working, and we're going to taper, and we're not just mad money printers, and we've done our job, and now it's time to get out. You were absolutely correct. The job isn't done from their perspective. Nothing has changed other than they pumped up the narrative that the economy was reaching escape velocity, things were getting better, and when they weren't, they blamed the weather. Now, we know that has nothing to do with the weather, and then you and I started to predict that they were going to use this pause period as a period to gain credibility, and then to say, oh, we did not anticipate this slowdown, something happened in the Ukraine, whatever it is, to get themselves back going. But they wanted to really appear to have this firm front that they meant it and they were going to stop QE, and they shrugged everything off as blaming it on the weather. Now, you mentioned initial jobless claims. You know that's a pet peeve of mine. That's one of the mechanisms they use to try to claim the economy is getting better when they say fewer people are losing their jobs. And they're at it again. You're right. The headline was, it's at a 7-year low. Okay, well, if there was any correlation between initial jobless claims being that low and job production, how come non-farm payroll is not at a 7-year high?
Exactly.
Yeah, so they will use anything, weather, or they'll try to claim, if you remember in 2009, green shoots, the next summer with Geithner, welcome to the recovery summer. Every year, the economy is going to get better in the second half of the year, and then they're surprised, and then they do QE1, QE2, QE3, whatever QE they need to do when they become surprised that the economy hasn't reached the level where it can stand on its own. And now they're starting to talk. Yellen walks herself back from when we finish QE for 6 months, that's when we'll start raising interest rates. Now she and all the other Fed presidents are saying, no, interest rates will remain low basically now for an indefinite period, which begs the question, if we've had this roaring recovery for the last 5 years, why do they need to continue low interest rates other than the economy is not doing well and the government cannot afford higher interest rates? And I saw
right.
Jamie Dimon. I don't know if you saw him yesterday. His interview, he comes out and he says that, look, it's time to stop worrying about the Fed. We can end the Fed's QE program, and there's not going to be a problem. Now, there's a prognosticator, a guy who has the blue whale trades, who pays billions of dollars in fines. The reason he can say things like this is it doesn't matter to him whether the Fed can or cannot end QE without any damage, because J.P. Morgan is going to be fine no matter what happens.
Right.
So he's out there now saying, and he also says interest rates, they'll probably raise on the 10-year bond from about 2.5% to 5%. That's not a problem either. That's not going to slow the economy. So he's out there, he's part of the Fed because J.P. Morgan has to be one of the shareholders of the Fed. So they're pushing this whole narrative that it's fine, we can stop QE, we'll just keep interest rates low, and if interest rates rise, not a problem. At least they'll get that right, that interest rates will rise. The fact that it won't be a problem is nonsense, but they can say, oh, it's unanticipated. We thought the economy could withstand higher interest rates. So like you say, all this is common sense, but it's all a game that they play to enable them to appear credible, to have confidence, so they can do whatever they want with monetary policy.
Yeah, exactly. And Lewis, you know, it's always interesting their timing, because they make mention of, you know, oh, well, January and February was rather slow, like, you know, compared to the end of last year. Now we're getting ready to head into a spring market, and it's like they're getting all this data that, you know, year over year, we have 55% less loan volume than the prior year. That's over half less of what we had the prior year. But yet they think that everything's moving in the right direction. If we had a healthy, stable market that was moving in the right direction, Lewis, wouldn't this be reversed? Wouldn't we have like an uptick in volume by at least 25-30%? Wouldn't we have some semblance of, you know, things looking like home values are stabilizing, not increasing in these rapid paces in these major metropolitan areas, mainly because of the cash transactions that are taking place? All this information, which is interesting because we talk about it each and every week, Lewis. It's like we're actually trying to predict when the Fed's going to make their move, right? Well, now, right before this spring market, I think that they're realizing that it's probably going to be a pretty dismal market, and they're trying to step back in and say, okay, what can we do? We don't want this to look bad, because if we go through the spring and these sales don't come in where we want, and, you know, loan volume doesn't pick up and permits don't pick up.
They're not ready to say that yet, Ryan. Look at the Washington Post. Yesterday, home sales in D.C. region fall for third straight month. Now, that's evidence enough that this isn't working and it's over. But home sales fell again last month, the third month in a row of year-over-year declines. And here's what they say. What do you think is in the first paragraph?
What's in the first paragraph?
Why they're down, the home sales.
Oh, why they're down?
Yes.
Is it rising interest rates?
No, of course not. Why do you think it's the cold, snowy weather hasn't helped.
The weather. Yeah, I mean, well, that's, I mean.
Now, why don't they mention that, you know, it says now the sun is shining and the cherry blossoms are blooming. This is like fiction. Home buyers and sellers will be watching anxiously to see if sales spots. Why don't they mention that the mortgage rates are up 30 to 40% over last year?
Correct. And you know, Jamie Dimon's mentioning that the 10-year yield could go from 2.5% to 5%, and everything would be fine. I can 100% assure you that whatever our loan volume is now, if it's down 55% this year, it'll be down another 75% the following year if it goes from 2.5% to 5%.
Right. He's out of touch with reality because he doesn't make money the way you and I or anyone else, when any common business sense makes money. He makes money by being the recipient of having the Federal Reserve print money and funnel to him so he can make bets, and when the bets go wrong, they bail him out, and if he happens to win a bet, he makes all that money too. He doesn't need to understand the economy. He doesn't need to understand business. He understands how to pay fines and how to I saw the SEC, by the way. The former chairman of the SEC was commenting on an interview that Jamie Dimon gave, and he said, he's such a mensch. That's one of the highest praises that Jewish people can give to somebody. I mean, he's just like a wonderful guy.
Right.
Now, there you see the cozy relationship when you see Maria Bartiromo on CNBC defending him. There's nobody else in the world that can lead J.P. Morgan like Jamie Dimon.
Right.
You know, it's this whole admiration society that they've built up about the Fed, like the Jamie, what's her name? Janet Yellen, as if she's some type of wizard, and she knows everything, and she can fix the economy, and Ben Bernanke and the maestro, Alan Greenspan. They build these people up as having superpowers, and therefore you must listen to them.
Well, in their eyes, they do have those superpowers, right?
Well, they do in a way.
Yeah,
they run the game.
Exactly, and I think that is the in the grand scheme of things, that's what's really taking place here is the Fed and all the major big banks. They are in control of everything that takes place. So, yeah, does it make sense for Jamie Dimon to come out and tout that it would be great or it doesn't matter if if the yield goes from 2.5 to 5, the economy's still going to be fine. Of course, yeah, it's going to be fine for you. It's going to be fine for you because regardless of what takes place, you're going to be there to be bailed out by the Fed if things go bad. And if there's opportunities that come up and you're able to buy real estate again cheaply because rates go up and property values go back down, then you'll benefit from that. You'll benefit from anything that takes place. You'll benefit from shorting the stock market if that starts to collapse. You'll benefit from anything because you have complete and utter protection.
Absolutely. If he wins, he wins. If he loses, he still wins. Yeah,
versus everybody else. You, Louis, me, and everybody else, we're not in that position. We have to make decisions, and there's consequences for those decisions. But it's very easy to live a life where you can just make every bet that you want and don't have to worry about how it ends up.
Who else can say they're going to print $4 trillion? If it works, it works. If it doesn't, oops. We'll just have to print some more.
Well, what banker comes out and says that there's not going to be an effect on the economy if it were to move from 2.5 to 5? That's a 2.5% spread.
100% increase in interest rates, and they're taking them seriously. In the where is it? It's a Fortune magazine article. Okay, QE works, says J.P. Morgan. Of course it worked for him, because without QE, without the original bailout, he wouldn't have a job, and J.P. Morgan wouldn't be around. There's little question that the Federal Reserve's signature stimulus boosted the economy and hasted the recovery. What's more, the Fed exit from QE isn't likely to reverse that.
Well, and what's funny, though, is that the Fed and Jamie Dimon, they're on two separate, levels of playing field here as far as when it comes to real estate, because Jamie Dimon, on the one hand, saying he hates it and he hates being in the mortgage business. I'm sure he likes the fact that there's rising asset prices. But on the Fed, they're worried about, why there's not more permits being pulled for single-family homes, why there isn't some sort of sustained improvement. Well, the fact of the matter is that Jamie Dimon's not taking all that money that they're able to borrow at next to nothing and lending out on mortgage. Loan production's down 55%. What they're doing is investing it back into assets, right, like stocks and everything else, to try to make more money. They don't.
Banks used to facilitate the economic growth of an economy by raising capital, lending capital to build businesses, and then they would take a piece for doing that, and they provided a useful service. They also provided a useful service as a place for people to deposit money and get interest. Now, they are nothing more. They don't loan money. That's not the main portion of their portfolios. Now they are basically a recipient of low interest, no interest money, where they go out and they bet on derivatives, which really don't add anything to the growth of society. And in fact, they don't even add to price discovery. It's not like when they're out there, they're really providing what an accurate measure of assets are by all this trading. They're actually distorting it by throwing a whole lot of money on it and then doubling and tripling and quadrupling down on the different bets that they're making.
Yep.
So banks no longer provide, and bank shouldn't be a dirty word. It is now for many people, because they don't provide that local service at the retail level, and on the corporate level, they really don't fund companies. In fact, what they do now best in company work is they bring overpriced companies with no earnings to the public markets so they can make fees, take a few of the shares, and make a fortune bringing companies that really are not creating jobs, are not growing the economy, and will be gone the minute there's trouble in the stock market.
Right. They're really the least productive companies out there.
Absolutely. They're not funding railroads. They're not funding construction plants. They're not doing any of that. They're funding game companies, Oculus. Well, that one they didn't bring public, but they bring those types of companies public, or they act as the advisor in those sales, which basically just means they write a letter and, they maybe do a little negotiation or help on the negotiation of the deal. They make huge fees on that. But they're not really they're not really a facilitator of the economy anymore. If they're not lending money to people to start businesses, to grow businesses, to get loans to buy homes.
Yeah, and we mention that all the time. It's like, okay, all these banks have access to basically free capital. They borrow money for next to nothing. But yet they're not actually pushing this money out to where it needs to go, into small businesses to help them grow. the small businesses would need to lead the way in growing the overall economy. It's not big business, because big business is what is got us into this mess to begin with. Big banks is what are benefiting, and the only ones benefiting right now from QE. And it's interesting because I think I mentioned on a previous show, 1 or 2 shows ago, that obviously where interest rates are right now, banks are still in a position where they're going to have very tight lending guidelines, where they're only going to lend to the cream of the crop, right? So that's why we've got about, a third of transactions taking place as cash transactions. The rich also realize that they're able to get a better deal if they pay all cash. The rich can turn around and always refinance that property later. Well, now, since the Fed's come out and say this, now we've got the information that loan origination or loan volume is down 55% from the year before. I've now heard the rumblings that, we had the whole qualified residential mortgages that had to meet all these quality standards presented by the CFPB, the regulatory agency that was put in place to basically mandate what type of loans could and could not be done to be sold to Fannie and Freddie. Well, one of the guys that was there that worked for the CFPB, Lewis, now no longer works for the CFPB. Where did he go? He now went and created a brokerage of some sort to give out mortgages that are now non-qualified residential mortgages. Because what are they finding? Well, lending's already tight enough, but now all of a sudden, if you have certain restrictions on debt-to-income ratios that are even more stringent than they were before, and somebody doesn't fit the mold, that's another reason why somebody wouldn't get a loan. So he's looking and he's saying, well, we're going to go create this non-residential mortgages. I want to say not too long ago, it was about 75% of the companies of major lenders said that they would not do a non-qualified residential mortgage. Well, now today, with how everything's kind of flipped, now almost all of them are now in the boat of saying that they're going to do non-QM mortgages. Why has that happened? Because they're not doing any loans. If they're not doing any loans, they're not making any money. So what has to happen? They have to start to ease up. Now we're going to start to move back into the territory of, okay, well, we'll start assuming some of this risk, and it might not be backed by Fannie or Freddie, but guess what? That's okay, because somebody else can create, billions of dollars and have it perform portfolio for a year or two, and then they'll start selling it back on Wall Street another way, right? They'll start to package them and put them together. They create their own products out of thin air, and typically the people that create them are the same people that lead these frickin' agencies. It's absurd. They create the rules, and then they go to another company to scoot around the rules, right? Yep. So, and they'll always say, well, we're not breaking any rules. Yeah, we're not. We know you're not breaking the rules. You just created a loophole that you could take advantage of them, and you could benefit, and you could make money from the same regulations that you put in place. So, what that would do, and the whole program that's being created for the non-qualified mortgages is going to be at very good rates. They won't say what they are. What that means, higher rates. Right. Okay? Higher rates. Higher rates means you're willing to take on more risk. Hey, this all makes sense. And so right now, if we had a decent housing market, we could afford for mortgage rates to go higher. We could afford, I actually personally think that it's not a matter of, just having low interest rates. There needs to be better underwriting systems in place. There needs to be, more realistic expectations, better loans for self-employed people. That would actually help the housing market for businesses that are doing pretty well that can't get a mortgage because the only thing that they care about is the bottom line on somebody's tax return, regardless of what somebody has in the bank.
But, Ryan, that's not what QE was about. QE was about pushing asset prices higher. They weren't trying to make sure there was wide participation in the marketplace if they can achieve that through smaller participation by wealthy people and banks, investors, and large companies to buy the houses. They managed to achieve it that way. And there's where the complicity comes in. When we have been told for years now there's a housing recovery, when the housing recovery is based solely 100% on rising home prices, not on household formation increasing, the homeownership rate increasing. Both of those are down, not on new home sales, not on existing home sales. not on the number of first-time home buyers coming in, not on an increase in wages, employment. It's all been done solely or considered a recovery solely because home prices have gone up.
Yep.
Mortgage applications down, pending home sales down. I can just rattle the stuff off the top of my head. None of this indicates that more people are doing better and are therefore able to buy houses. But home prices have gone up, so the media screams recovery.
Yeah.
And now that home prices, that's the one part of the recovery that at least they can point to and say is working. Well, there's a limit to that. Home prices can't go up much higher because, first of all, retail buyers haven't been buying them at these prices, and investors are going to stop buying them. So what are they going to call it when no one's buying houses and home prices stop rising?
Right.
Well, then what are they going to do? Where's the economic recovery? Well, it's in the stock market. The stock market's going higher. Well, what happens when that goes down?
Well,
then you have no recovery at all. You spent $4 trillion, and the economy goes right back down into the tank. And what are they going to do? More QE?
Yeah,
Yellen's going to help the labor market. That was her latest thing, right? We predicted that in October when she took over the reins. She was going to make sure people had jobs. Well, I don't have jobs, so what's she going to do?
Right. And I think that's why they're already tipping their hat that it looks like that they're going to have to come up with something else. They're going to have to come up with some other, creative option for people out there. I obviously mentioned that they're going to, have to start mandating that some of the money goes to small business. They're going to have to do something because obviously the path that they've been traveling for some time now hasn't worked a lick. I know there's been many rumblings now, Lewis, of, the stock market. And see, yesterday when initial jobless claims came out, typically that would have thrown the stock market much, much higher, and the bond market would have got worse, and interest rates would have got worse, right? Because that reading was better than expectation, correct?
No, it was worse.
Well, as far as the jobless claims that came in, the initial jobless claims came in less than expected.
Correct. That's good news because that normally would make you think that the Fed is going to lay off on the taper and is going to continue QE, but they've been so adamant that nothing is going to change that tune. And
correct.
Therefore, bad news was bad news.
No, I meant it was bad news is for mortgage bonds, okay? Because typically the stock market rallies on that good news, but the bond market gets worse. Well, yesterday that didn't happen. It actually kind of stayed pretty level, and they started, pointing to, a lot of global uncertainty again. Now there could be an IPO bubble that's taking place in the stock market.
Really?
You know what I mean? There's always these other narratives that come up. Just when we think that interest rates are going to make that huge jump forward, Lewis, there's always something that brings us and keeps us right in line, not letting them get to that 5% range. There's always something that does that.
One thing, Ryan, that you and I have talked about. It's not a black swan that will take it higher, and the Fed won't be able to control it. It will be an event outside the United States, and this Russian thing will come back to us. Russia and China are buying enormous amounts of gold. They're making big deals to trade amongst themselves, not using the dollar. And basically, if they don't even have to dump their U.S. treasuries, and the reason they don't dump them is because it would harm themselves, but at some point they'll get to a level where they have enough gold where they can force the price of the dollar down by not using it, creating a lack of demand in dollars, thereby pushing up the value of their gold reserves, offsetting any losses they may make by holding dollars. And then the United States is in trouble, and there's nothing the Fed can do about it because our imports from Japan, the prices would skyrocket. And by the way, you saw the other day, beef hits an all-time high, but there's no inflation. An all-time high, right? So if that happens, Ryan, and it is going to happen, that's where Russia and China are leading their economies away from the dollar, trading with Iran, trading amongst themselves, doing gas deals between themselves. Russia bought oil from Iran. Now, that doesn't make a stitch of sense. Russia doesn't need oil. Russia produces more oil than Iran does. So why are they doing that? Well, they're doing it to test a non-dollar transaction. Now, the United States is not going to sit by and allow this. They're going to do sanctions. The problem is we're not in the driver's seat. It's not like we can withhold production and exports the way Russia can to Europe with oil and China can to exports to us. There's nothing we really can do except force use of the dollar. Well, that means war, but we're not prepared to go to war with Russia and China. We can go and clean up on Libya and Syria and little countries like that when they step out of line, but it's not like you can push Russia or China back into line. So that's something I think, Ryan, this year is going to happen gradually to the point where you'll see rising prices, not due to inflation in the normal way because of an increase in the money supply, but more because the value of the dollar will continue to drop. I don't know if you've noticed, it's dropped about 2% in the last week and had no impact on the stock market, I guess because people feel if the dollar goes down, at least the stocks keep getting boosted, their nominal values go up, and they can offset the dollar value loss.
Yeah, I mean I did notice that, and I guess people do get caught up in the nominal value of the stocks there. And I think you are right. I mean, I think we talk about it all the time that there's some big event that's going to take place, and I mean, these other countries have been watching what we've been doing with QE for how long now, right?
You think they like getting their reserves devalued through QE?
No, they don't like it, and they know that we're playing this game. And you know what? It makes all the sense in the world why Yellen, when she takes her post, would give a clear signal to all these other countries that, hey, we're going to be pulling back our QE now, right?
Right, because not just for the American investor, but to the international investor, it looks like, oh, so this is all for your benefit. You guys got the world reserve currency, you're abusing it to our detriment, and you're not going to stop. So they have to come out and say we're going to stop. And maybe the way they continue to again is say, well, you forced us because you put in all these sanctions or you started not trading the dollar.
Right.
At that point, they can go back to printing as much money as they want.
Well, with all the QE they've done, it hasn't really helped us at all here on the home front. I mean, and then now they've started to pull it back, and now they're it looks like things are worse than what we had originally thought. I mean, this is the same
And they're going to
thing.
get better because they stop? Eventually they will, but in the short term, if you pull the stimulus back, it's not going to get better.
No, it's going to get much worse, matter of fact. But
worse.
But you have to go through the pain to get through to the other side, and nobody's willing to absorb the short-term pain.
Like you said, not on Obama's dime.
Not on Obama's dime. It's not happening, and that's why I'm curious. Like you said, if there is an event, Russia and China spiking up within this next year, it could kind of change things altogether because it would be something that might be forced down our throat more than anything else.
Well, here's the thing. What happened? Let's say the dollar falls. I'm not talking about dollar collapse. It falls to the point where we see it in price inflation here. We see it in a drop in the stock market. Well, that's when the Fed comes in and perhaps starts getting creative about what they're going to do, and the government starts getting creative about who has to buy Treasury bonds to support the country during this time period. I wrote an article, I think it was last week, about how, well, we all criticize the Fed, perhaps rightfully, but executive orders are what has really, in one swipe of the pen, a president can do more damage than the Fed can do with all this money printing and policies. And I mentioned FDR's confiscation of gold in the 1933, and then after he took it, they revalued gold, up 67%, so people lost a lot of money when they turned their gold in. Nixon in 1971, stroke of the pen, instituted wage and price controls, and then took the U.S. off the gold standard, leading to another devaluation of the dollar. There's nothing stopping. Obama's already said, I have a pen. He's got his left hand ready. Who knows what damage he can do if the United States appears not to be having a good time financially in the economy. Right. He could easily say, from now on, pension funds have to have a certain amount of Treasury bonds. They're safe. They're guaranteed. He already floated that balloon with his Myra proposal that he made at the State of the Union. So something is going to happen this year, and maybe the Fed won't be able to come up with something creative, but our president, with his pen, may be able to. and get it done right away.
Oh, absolutely.
Because it doesn't look like this MIRA thing is going to cover the bond sales that the Fed's not going to make. In other words, if the Fed stops buying bonds and there's no readily available buyer, Russia and China aren't buying them anymore, so who's going to buy them if the Fed isn't buying and they're buying 70 to 90% of them? The MIRA campaign is selling any of them. They're going to have to force in a big way, and the only way you can do that right away is executive order.
Which I can see happening.
Absolutely. Especially with the
100%,
president who's already said, I have a pen.
Right. I mean, they've got, and especially with the amount of, government plans that are out there, you know what I mean? Right off the bat that they...
for bail-ins, and yes, of course. They're prepared for whatever happens. There's an exchange stabilization fund where they can buy things if they want. There's just plenty of things they could do. They just don't always do them. But they can do them in a moment's notice. And
it's pretty sad, Louis, that we're having to sit here and take a guess at what the next potential bad thing that's going to happen is, right? Where if from the very beginning, if before QE even happened, or let's just say that they did do the initial bailout to the banks, but after that they said, you know what, though, you're going to have to build yourselves back. We're going to pick you up one time, and you're going to have to put yourselves back. We're not going to have this continuing printing of money, this infinite printing of money. And we went through a period of time, let's just call it a 2 or 3 year period, where things didn't go very well. I mean, let's just say that, there weren't very many jobs. There wasn't much production out there. At some point, we would have came out of it, right?
True, but the banks wouldn't have. And they required the QE because the initial bailout wasn't enough. It still isn't enough. You mentioned the other week the shock that they did the stress test on the top banks, and after 5 years of pumping money into them, 1 or 2 of them failed.
Right.
So that's why they couldn't have done that. But you're right. Had they done it, we would have had bank failures. We'd have had unemployment. We'd have had a nasty period. It's kind of what Volcker did in the early 80s when he took over. Well, he took over during Carter's period. But in the first 2 years of Reagan's term, it was a horrible economy. They called it Reaganomics, and there was high unemployment, and the inflation was still there. But by raising interest rates and allowing the economy to restructure, that's what created the prosperity of the mid and late 80s.
Right. Well, and the whole QE thing was not about helping the masses.
No.
Right? It was never
keeping
about
the banks in business.
But
that's what Bear Stearns is about. That's what they were all about. And then eliminating competitors. That's why they let Lehman go.
But in the same token, they act like that they're completely committed to employment and all these things that really the masses are having problems with. Well, your real core issue, guys, is that your plan, your quantitative easing plan that's been in place is only meant to help the 1%.
Borne by the banks, and then if they get help too, that's great too.
Yeah, I mean it is unbelievable. I mean, I honestly we always joke about this, but it's like, I mean, if you gave any business the ability to just borrow money at nothing and then go out there and create businesses out of thin air, they would be successful because they never lose anything.
You can't lose.
Yeah, how great is that?
First of all, even without QE, how could you possibly lose money as a bank? Because everybody knows how a bank, well, not everybody knows how a bank works. You go in with a deposit under the current rules, and you give the bank $1,000. Well, they immediately turn around and create $10,000 worth of reserves. Okay, so they just made $9,000 on your $1,000, and all they got to do is give you your $1,000 back with a little piddling amount of interest. Okay, then they take that $9,000 and combine it with 100 other deposits just like yours, and they have $900,000, and then they loan it out.
Yep.
Money that they never did anything, so you gave them the money, then they create 10 times the amount of money that you gave them just to give them a little interest back, and then they loan it out at a much higher rate than they're going to pay you. And it's money out of thin air so they don't even need Federal Reserve to put money in for a bank to work. So if you mismanage a bank, you're like a bozo. You may have a bad loan or two if you know how to manage your portfolios and lend properly. There's no way you can lose money owning a bank.
Well, I have a better question for you. So how does a bank ever fail, right, when they can lend money out at 10 times what they take in? But better yet, how much more successful would any business be if they were able to just borrow money at nothing?
Right.
Right?
But not just borrow money at nothing and then say, well, now I've created 10 times more reserves after you've lent me the money.
Right. I mean, if somebody would lend my business to start up a business $500,000, and they
which
told
would
me
mean $5 million.
Right, and $5 million, and I only needed $500.
You could create 10 times reserves off of the money they lend you.
And do you know what that really shows is that how inept these banks actually are at running
Correct.
a business.
And then they have to charge you, like, overdrafts and all that other stuff? That's crazy.
Right. Yeah, I mean, they should be making piles and piles of money. I mean, it's really...
you lend them money, and then they charge you fees. As a depositor, you give... It's unbelievable.
Yeah, it is. I mean, it's when you think about it, I mean, like, you could start a bank with, no fees, and, I mean, even if they lent money out, at next
slightly
to
higher.
Nothing. Yeah, just slightly higher.
But you know why you can't do that? Your regulatory burden, you never get past start. That's why, right? If you think about it, the best business to have is a bank. I would start a bank tomorrow. I'd get 10 friends together who might have some money and start a small bank because you can grow a bank. We wouldn't get past the regulatory costs and compliances.
Yep.
Capital requirements, you wouldn't be admitted into the Federal Reserve System. Then you'd end up being basically a loan shark. Now, of course, that's criminal. You see how your banking operation becomes criminal because it's not sanctioned by what they do.
Yeah.
Their criminal activity, as long as it's sanctioned, is fine. Just like when the government runs the lottery. You try that. That's like the mafia lottery if you're running numbers, right?
Yeah, and then a lot of these local banks, Lewis, the other restrictions that a lot of these local banks have is they have, like, territories. Like, they can, they can't do business but outside of a certain territory because they don't want them to grow too big, right?
Thank you, yes.
Yeah, I mean, they're able to impose all sort of restrictions on these small banks that are trying to be the up-and-comers because they don't want them to be able to ever rival a Bank of America or a Wells Fargo because that's set for the elite, right?
Absolutely.
And
they do that because they own the politicians who write the regulations or who are in the Congress or the Senate, or they donate to the presidential campaigns, and they ensure that they remain entrenched.
Yeah.
Think about it. If you look at the presidential campaigns, who donates the most to Republicans and Democrats? It's banks.
Oh, absolutely. Well, they should have the most money, right?
Absolutely.
Yeah.
If you think about it, that no other business has that kind of clout. If every business at the top level, real estate agents have the National Association of Realtors, but if you just run, for example, small farms, they have no representation. Why? Because someone beat them to it. The large farms, Monsanto and so on. Right. So they're actually going to turn against you if you want to use, for example, one of these issues is raw milk. Well, they don't want to hear about raw milk, so they'll come to your place with guns and make you give up the raw milk as if you're selling something that's a danger to society. And why does that happen? Not because the public wants the government to go after these people. They could care less. In fact, they don't want them to go and raid raw milk factories. But who wants them to do that? Well, the large farm companies that pay for influence. And that's what you see all along, where if you're large, you can influence the government and get the government to do your bidding. And the best part about it is it's all legal. There's a regulation that says, hey, you can't do that. Well, that regulation ends up protecting the larger entrenched competitors because they can afford either to not do it or they could pay the fine if they do violate the regulation.
Yeah, and another thing is, too, like, so let's say that there's an innovative business that comes out, right? Like that's, the solution, like the solar-powered car, or some other sort of technology that's even cleaner, even more efficient.
Right.
Typically, those companies, they get all this angel fund investing in their company, but at the end of the day, they just don't have the capital. So what ends up happening is a bigger company like ExxonMobil or something comes along and offers some sort of absurd amount of money that they can't pass up because guess what? They don't have the capital to actually grow this into a viable company, right? So there's another company that swoops in. There's an innovation that there would be probably how many other solutions out there to how many of our problems if companies would have actually been able to go from start to finish with their product.
Well, look at Thomas Edison. One guy, he was inventing light bulbs, televisions, every week he was coming up with something. That
right.
type of they talk about innovation. That's like the prayer word in Silicon Valley. But you really don't see, I think, you're right, we should be much further along in human progress and technology.
And the reason why we're not is because the big conglomerates want to protect themselves, and they want, especially like the oil industry and things like that.
Just so light bulbs. There's only one light bulb you can buy. It's a GE light bulb made in China that complies with the standards.
Yeah, and now we've moved into where...
And if you drop it, you got to call Hazmat because there's mercury in it.
Yeah, but now, today, we have even less productive companies, not really productive at all, Facebook, that's turning around and buying $20 billion companies here, $2 billion companies here.
What's the primary focus of Facebook? Basically to collect data on people.
To collect data on people, which...
that doesn't serve you or the consumer. You may be having fun giving your opinion and looking at pictures of your friends' kids, but that's not productive behavior on the part of the consumer, and it doesn't drive the... And by the way, those ads on Facebook are 100% useless.
That is true. I mean, people end up getting extremely, tired of using a platform when they know that, Facebook was completely free before, but now they're shoving information down your throat that's not what people want to see, right?
And that's one of our largest companies, and you would say an innovation, that's out there in Silicon Valley. Twitter, okay, it's a communication device. Another billion-dollar company. Look in real estate, Zillow and Trulia. What actually do? They post listings. They can claim innovation all they want. All they're doing is posting listings, and for some reason they have market caps $1, $2, $3 billion.
It's unbelievable to me that, by the way, with that. I mean, yeah.
I give them credit for doing it, but how hard is it to do that? Well, the reason it was hard gets back to regulation. The NAR wouldn't allow their listings to be posted online.
Right.
Why?
Yep.
How else are you going to sell real estate if you can't see the listings?
Exactly. Yeah, I mean now there's about 1,000 of those sites, right? They're all over the place,
right.
And but really, I mean, there's not much innovation as far as you're posting a listing online. Great, that's where everybody needs to go to look for them now. But I just really do feel like that that the times, the economy that we're in, we're wondering why we're not moving ahead. They're between the regulation and the lack of access to capital to be able to get loans from banks, so everybody's having to turn to crowdfunding. And even when they're getting the crowdfunding, they're getting the product just to the stage that they need to get it to sell it to another company, and then it's out of their hands again, and then they go and start another something, right? They never get to the best end product that they could possibly have. Because
Brian, the companies that make the most money are the companies that lose the most money. We just mentioned Trulia and Zillow. I mean, the key there is not to make money. The key there is to go public and to convince the public that one day you will be profitable. And if you just show enough growth, not profit, you've already won the game. It used to be, if you remember, like Microsoft. Microsoft is a classic example of a stock that went high and a lot of people made a lot of money off. But that stock really didn't take off until they showed how much money they were making by selling Windows. It wasn't a multi-billion-dollar company before it sold anything.
Yes,
and that's what you have now. Oculus sells for $2 billion to Facebook.
Right. I mean,
the product doesn't even work yet.
I have a small real estate investment company, and I must be in the wrong business, Louis, because, I mean, I actually go out there and physically buy real estate. You believe that?
And you make more money than Oculus ever made, and perhaps may ever make.
Yeah, I don't have to.
You should be worth $10 billion.
I should be. I don't understand why I can't get funding for $10 billion to continue doing what I'm doing. Right?
Yeah.
And that's the funny part. So if I were to go to another bank and say, okay, will you give me a credit line for $1 million to buy properties on? Why can't I get $2 million when I've proven myself that I'm making money on that money? You're always getting your loan payments. Your loans are always paid off in less than 6 months. Well, we are limited. We are limited because we can't give any more to one person than this allotted amount. Where does that come from, right? Well, that comes from the regulations that are set forth on a lot of these smaller banks. They can only lend so much. They can only have so much exposure to one person or entity.
I like when they try to be fair when the whole system isn't fair.
No. Yeah, I mean, so we need to find a way to get in with Jamie Dimon is what we need to do.
Yeah, well, you know what George Carlin says, it's a big club and you're not in it.
Exactly.
So you're not going to get in with Jamie Dimon.
But he definitely does. I mean, when he opens his mouth, I mean, it almost, I hope he realizes that it almost makes him look ignorant for the people that are out here watching what's actually taking place.
Well,
right?
do you remember when they had the Twitter Ask JP Morgan? They got so many embarrassing questions, they just had to cancel it.
That they had to shut it down, yeah.
They decided we're not answering these questions. Just airing them makes us look bad. We have no response to questions like, and one of them was like, did you always want to be I can't even remember. They were hysterical though. And they were really cutting at what JP Morgan does and who they are.
Yeah, and I mean, I think it's pretty much spot on.
And they don't even need PR. You think about it. If you and I had a company and we had a disastrous public relations, we'd be done. If you have a disastrous public relations, meaning, okay, no one's going to do business with Ryan and Lewis anymore because everybody knows they're criminals, or there's the hint that maybe they're engaged in nefarious or unethical dealings. Well, you'd be done.
The very next day, right? Very next day.
In fact, you already are done when you have to go and give this kind of PR. And then if it ends in a disaster, where you come out and you say, look, we're going to present our best foot forward. We want to give this warm and fuzzy feeling to the public. And then in the middle of it, you cancel it and you say, no, that's okay. Well, that should be the end of your company. There's no goodwill left. Well, you think that was the end of JP Morgan? No. They don't need the goodwill. Does it matter? What can you do? They don't care if you deposit money there anyway. That's not how they make money. You could stop using JP Morgan tomorrow. That's not going to impact them. They're making their money on trading. Don't trade with them. How often do you trade with JP Morgan? Are you involved in? Are you on the other side of the London whale trade ever?
Exactly. And you know what? You bring up a great point, because how many times have you heard the horror stories of people going into banks and having bad experiences and basically threatening to close out accounts, and they could care less?
Of course they could care less. In fact, they'll tell you can't close your account because we're not giving you the money until you give us a good reason why you need it.
Yeah, matter of fact, there's going to be a 30-day hold on getting all those funds too. You know what I mean? Well, what do you mean there's a 30-day hold? I want my money today. We can't give that to you today because we don't have it.
Right. If you and I had an agreement and you would let me money and I told you I wasn't going to pay it, well, you'd have every right under our common law system to sue me to get your money back. There isn't a regulation that says, well, I don't have to pay you, Ryan, because I may suspect that, you may use the money in a way that I'm not aware of. So I'm not going to give you your money back, Ryan. Think about it. An average person can't pull that.
No.
Can't say I'm not executing my contract because there's a law that allows me to say I don't have to pay you back.
Yep.
And the bank can get away with that?
They get away with it all day long.
Of course.
Yeah, I mean, it's a crazy industry out there as far as the banking community is concerned. I mean, I did want to touch on one thing, Willis, before we come to the end here, that a lot of the questions I've been getting has been people watching mortgage interest rates go higher, and they wanted to basically get my prediction on where interest rates are going into the spring, and I really think that it's going to be very up and down. I don't think that necessarily they're going to jump too high unless an event like what Lewis and I talked about, Russia or China, something pops its head up that's a major event.
Right.
But the technical indicators are showing that, the 10-year bond has been struggling to hold below the 2.7% level. And I don't really think that there's going to be anything, especially with what the Fed's coming out and saying that they're holding emergency meetings, that the economy's not doing certain things. So I think, if anything, it's giving us an indicator that they're going to be watching, and they don't want interest rates to go much higher. Now, what can they do? Not much. Do the same of what they've been doing already. So for people out there that are thinking about interest rates and, obviously moving forward, I'll give you the same tip that I do every week. Don't worry about where interest rates are headed. Look at them today. Does it make sense for you today? Because
and if they're low, Ryan, it makes sense to lock them in.
Well, low is low, right? Because anything, to me, lower than 5% is fantastic, right?
They're not going to go much lower.
No, don't get caught up in I want to wait until they go back down to right at 4% or right at 3.875 because
they may not.
They may not, and you're going to miss the boat. And what happens if they go up and they're 1% higher than what you were trying to get?
If they go up, they will go up fast, and you'll get caught off guard. If they go down, you'll see it. It's not like they're going to just plummet.
Absolutely. So what we'll do is we'll keep our eye on what's going on with the Fed, because that's the only thing that matters these days, and that's why we have to talk about it each and every week, because they're always giving us some sort of great information that we get to to comment on, but I think that overall interest rate should stay steady, and I don't really think, as I always say, anything bad is going to happen on Obama's dime. It will not happen.
If it does happen, it's an outside thing that happens, and there's nothing you can do about it.
Yep, an outside force.
If the Fed can control it, and they've proven to date that they can, to back up your point, they will keep rates low.
Yep.
It's only if external forces in the market force them out of that low interest rate.
Correct. So I'm just going to stick to that story until I'm proven otherwise. Lewis, I want to thank you for coming on as always. If you could give our listeners your blog so they can go and check out your weekly blog.
Sure. Smallgold.com, SMAULGLD. And there's a blog post there at least once a week, sometimes 2 or 3 times, depending on my schedule. And it deals with the Federal Reserve, gold, silver, real estate. So please check that out, smallgold.com. Thanks, Ryan, and thanks, everyone.
Thanks, Lewis. Appreciate it. Guys, if you'd like to subscribe, download us on iTunes, search in the bar Real Estate 360, and you can subscribe to our podcast. If you'd like to stream it live, you can go to realestate360live.com. That's realestate360live.com. Until we talk again. Thanks.